Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, February 27th, 4:42 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. It's the 27th, not the 28th. So, state of the market, we are in an uptrend, short-term caution as we've had about a week's worth of closes below the now declining 21-day moving average on all of the indexes. That is our short-term trend indicator. If the short-term trend is not in your favor, you best be governing how much exposure you have to the market. So you can see over here on the trend gauge, market leadership still flashing bullish. None of the 21 over 21 broke that key 21-day exponential moving average today. Leaders acting just fine. In fact, I made two complete 21 over 21 lists over the weekend. There are a lot of good setups. We just need the overall market to cooperate. Short term, however, as I mentioned, we are in bearish slash downtrend mode for all five of the major indexes below their 21-day exponential moving average. Medium term, we're bullish, but with the yellow sub arrow as the Dow has broken below the 50-day moving average and the slope of the line of the 50-day is rolled over. Long term, we're neutral. All five indexes above their 200-day moving average, but the slopes of the line are varying between barely higher, barely down, and flat. So what happened today? Well, the day started off great. Woke up to green futures. Then we had some weak economic data before the open. That weak is good for the market, and because it supports what the Fed's trying to do with inflation. They're trying to slow the economy to tame inflation. So we had a nice gap up, made higher highs early within the first 30 minutes, 45 minutes, but then just rolled over, kept trickling lower to the point to where we gapped above the 50-day moving average on the S&P. We broke back below it late in the day, but reclaimed it into the close. But the afternoon was weak. So we're calling it a neutral day, even though we finished green, weak green finish. Here are the numbers. G6, this is our 6 ETF growth proxy, up 0.59%. S&P 0.85% gap up, back to flat and closed up 0.3%. NASDAQ 100, the leader today, up 0.7. Dow up 0.2. Mid caps up 0.2. Russell 2000 small caps up 0.3. Same with global diversified 60/40. Stock and bond up 0.31. In-house GROTECTION up 0.2%. We'll check the tail of the tape. And then the focus list. Let's get right into it. What do we do here at Revere? Well, first, let's set expectations. What type of market are we in? We are trend followers. So that means that there's going to be times when we have more exposure than the overall risk in the market when we're in a strong bull market. And then there are times we're going to have minimal to zero exposure when we're in a severe bear market. So depending on what the market conditions are, dictates what our exposure should be, and therefore what our expectation of returns should be versus the S&P 500. So bear one is where we are just barely missing severe bear market. Not where we are, where we were in 2022. Market down at the worst 27.5%, our worst less than half of that. That's some nice outperformance there. When we start coming off the bottom, we're going to have moderate underperformance as we identify leadership, get on board, look for signals that a low has been established. So this is, we call this early recovery or a bear market rally. It kind of overlaps with bull one up here if it gets some traction. And then if you spend most of these in some sort of a pullback because you're not making new highs every day. But basically, we're in line, minor outperformance, minor underperformance during these three cycles: bull one, bull pullback, and correction one. We're in correction one right now because we're down over 5% off of the highs. If we rally and get uh, into where we would expect to be where we are on the indexes, and I'm specifically talking about the S&P, less than 4% off the highs and get back above the 21, we'll start ratcheting up our exposure. And then hopefully get into back into bull one, bull two, or bull three. An example of bull three was late 2020 after COVID, when there was a very strong bull market in growth stock. So this is our expectations for where the market are right now. We're in mild correction territory. So here's the S&P. Depending on those market breakdowns that I just showed you, that dictates how much exposure we have to the market. It's based on 3 time frames. What are the indexes doing relative to the short term 21 day? That's the green line. The medium term 50-day, that's the red line. The long term black line, that's the 200-day. Why do we worry so much about the black line? Because all bear markets occur once you break, the risk is there once you break below the 200-day moving average. We're hanging on uh, for the last week, holding on to the 200-day moving average. We bounced off it once, battling between the 50 and the 200-day. As you can see here, the red line. We lost the 21-day last Tuesday with the rollover, and any attempts at a rally have been thwarted by the declining ultra short term. That's the 8, the purple line, and the green line, the 21. Until we get back above there, we have a governor for our exposure. So if we're above the 50 and above the 200, we can get as much exposure on as 1.0, which is what we ratcheted it up to this morning when things were working okay. A little bit of a pullback, as I mentioned, with a weak close, but we did finish at 1.1, and we'll show that when we show the tail of the tape. So right now, basically, let's take a look at the 5-minute chart here. Here's the nice gap up, make a higher high, roll over, lower lows, lower highs, little bit of an attempted rally, but it looked like we got above 4,000. We pulled back below it, tried to get back above it, failed, tried to get back above it, failed. So 4,000 is acting like uh, resistance now on the S&P 500. We undercut right here the 50-day moving average, but got back above it into the close. It's at 39.80, 39.40 is where the 200-day moving average is, just for reference here on the daily chart. In oversold territory, when the market was healthy this morning and rallying in the afternoon, we did see a little bit of a hookup in the stochastic here. So any renewed strength that we have will be a big change. This is a 14-day look back period. There will be a big change from the downtrend that we're seeing, and it'll hook back up quickly. And then any sustained strength will get us off of oversold, and that'll be a tailwind for the market to go higher. NASDAQ 100, this is the QQQ, failed. You can see this declining 21 is acting as resistance. The 8 and the 21 are right there, overlapping. It also bounced at the 200-day moving average. It's also near oversold territory here. Let's go to the Dow, the weakest of the indexes. Gap up along with the other markets, closed near the low of the range, below the 50. The 21 cutting down through the 50 now. That's a negative cross, and we are in oversold territory. Dow just really hasn't been able to get much going. It went sideways here while we were having most of the correction, and now the relative strength line is flagging off as we pull back, basically in line with what the Dow's doing. Let's go to midcaps. MDY made an attempt to get above the 21 and the 8 today, but reversed along with the rest of the indexes. Hey, at least the indexes were consistent today. Closed back below the 21. Nice move above today's high would be a plus for the bulls. Maybe we need to see more weak economic data to get that feather in the bull's cap, but you can see we're oversold there. Also, small caps IWM, same thing, tried to get back above the 21, declining 21, but we failed, and we're oversold there also. The equal weight indexes were basically similarly in line with no major divergence versus their market cap weighted indexes. So let's go to when that data came out this morning, weak economic data, the dollar gap down, flashed weakness. You can see the V shape here. Uh, Complete opposite of what the market was doing. Dollar going lower, market going higher. Dollar reversed, market came off. Dollar faded into the close. and then real tight. Something's wrong with this. That doesn't look consistent, but the dollar did close down 0.53% today. Let's go to the VIX. We'll go to the daily chart of the VIX, and the VIX is down again, but above the 50 and the 21-day moving average and above this 20 area. We want to see it get below 20 to provide a tailwind for the bulls. Let's go to the broad bond market, BND. Bond prices up today. BNDW, though, world bonds, so I guess foreign bonds were weak, meaning interest rates rising overseas. But here, the bond, all of our bond indexes that we're going to show here, positive on the day, meaning a little bit of a pullback in yields. That's the broad bond index. Here's the corporate bond index, barely up. Here's the junk bond index, up, along with stocks finishing positive, TLT up, but an inside day. So let's check the yields. Here's the 10-year yield, 0TNX, down 0.7. Really 5 tight closes here, the same way we've seen 5 tight closes on the indexes, except we're trending lower and not higher. You can see we're in overbought territory on rates, heading lower, just the opposite on the bond proxies. For example, look at TLT and you can see we're oversold, looking to come off of that. That also would be a tailwind for the bulls. So the setup is there, but it hasn't triggered. Looked like it was going to try to trigger this morning with the gap up and the higher high, but market said no such luck, and we reversed. Let's go to the long-term bond yield now, also down 0.5% today, inside day. Let's go for the gold. Dollar was weak. Does that mean that gold was up? Yes, indeed it does. Not up much though. 0.39%. GDX gold stocks also up 0.78%. Silver still making lower lows. That's just something, the way that showed strength and then fell apart. And again, you have to trust price, not what your opinions are on any of these things. Bitcoin, basically flat on the day. So those are the major indexes that we show. Let's go to the tail of the tape now. You can pause the video if you want to read some detail on this, but the key takeaways are that durable goods orders was what was weak. That popped the futures, rates down, UUP down. Those are down arrows, but they're in green because it's good for bulls. We did have strong housing data that didn't seem to impact the tape much. So we've gone from down 5 out of 6 days to down 5 out of 7 days. With the up day here, even though it was a negative reversal, 7 days below the 80 EMA, 5 days below the 21 EMA. Reclaimed the 50-day, gapped above it, failed, reclaimed it at the close. Major sectors that were green, gold and gold stocks, solar, transports on the downside. The dollar and yields and defensive sectors were weak today. Financials, staples, utilities, and healthcare. This is what we own in-house. Early in the strength in the day, when we made a higher high, added to SSO, added a little bit to NVIDIA and Palo Alto, trimmed TBT as locked in some profits on that. That acted as a nice hedge. So upped our exposure from 0.8 or 80% of the S&P to basically in line with what the S&P is. Bottom line for today, gap up, negative reversal. The green closes at best a tie for bulls after giving up the nice gains that we had in the day. So let's run through the portfolio. What we own here, TBT, we trimmed on this. This has been a nice counter trend trade for us. Inside day, you can see the stochastic rolling over. That's really why we just booked the profits on it. The setup, as I said, is there for rates to go lower, but we do need a trigger. Tesla was strong today, still below the declining 200-day moving average, but showing some nice neutral relative strength, which, while you're consolidating after a nice move up, is pretty bullish. So I'm liking this setup. This is a stock that can absolutely lead. They have AI They're having AI Day on Wednesday. That could very easily be a sell the news event if nothing eye-opening happens. We'll see how that plays out. But for now, we're sitting with a small piece of Tesla ready to add to it if we get positive action. TMDX, we had a nice gap up on earnings with this and added to it last week. It was weak most of the day, but finished nicely today. Three tight closes near the high of the gap up. That's about the most you can ask for in this market with a gap up. Revance RVNC, this is the Botox replacement. Earnings tomorrow after the bell. Nice day here, up 3%. Airbnb, we've trimmed this back quite a bit, but it did what it needed to do, bouncing off the 21 day, which is also the pivot of the cup and handle. ANET, acting fine, 2 bounces off of the 21 inside day. Not a lot of action on this one today. Iridium pulling back after its 2 big days up. Bounced at the 21 today the way it needed to, and we added to, we still have a very small position in net, holding the 21 as it should. Would like to see this break the declining tops trend line here and get above the 80 EMA. We're seeing a lot of leaders set up where they can't get above the 8, but they're holding the 21. Again, we need the catalyst to trigger to get them higher. Making a new high, Palo Alto today, we added to the position on this strength. It pulled back along with the market. And then NVIDIA, we also added to it on the early strength. It pulled back along with the market. So uh, that's a portfolio review. And of course, we have 0.5% of our beta. So we're basically split between stocks and indexes. As long as we hold on to the 50, we'll hold on to that. We cut some of it last week when we broke the 50, but held the 200. We cut some of it earlier in the week when we broke below the 21. What we're looking for is a trigger that we can get back into those higher, get our index exposure to 0.6, which is where we ideally want it to be when we're above all three of the major indexes, and get some leading stocks working. They're working better than the indexes right now, but 80% of stocks follow the trend of the overall market. We need the market wins behind us. That's going to wrap it. Reminder, it's not how much you make in the markets, it's how much of that you can keep. If you like the way we do things here at Revere, reach out to me or my partner, Dan Stewart, Don or Dan at revereasset.com. The phone is 855 Real Wealth. That's 855 732 5932. Remember, it's not how much you make in the markets, it's how much you can keep. We're ready to put more capital to work if the market wants to participate and go higher. We're also equally ready to cut if we break below the 200-day moving average, because we're aware of the danger that can cause being below the declining 200-day moving average. And it still is declining today by only 9 cents, but at 39.40, it is declining. That's going to wrap it. And I'll end up Monday, February 27th. Don Vandenbord telling it like it is. Thanks for listening and have a great day.